So let's look over chapters 5 and 6. So
Okay.
in chapter 5, we start seeing these journal entries dealing with merchandising companies. So this first problem, it says on October 10th, Jones Company purchased $7,000 of merchandise from Taylor Company. FOB shipping point, terms 210 net 30. The goods cost Taylor Company $3,000. So before we move on too far, let's talk about what that part means. So the FOB shipping point means that the transfer of ownership happens when it's shipped. So the buyer will have to pay for shipping. Terms 210 N 30, which we read as 210 net 30, means that the buyer will get a 2% discount if they pay back within 10 days, or they have to pay the net, they have to pay all of it within 30 days. And then it goes on and says the goods cost Taylor Company $3,000. So Taylor Company is our seller here in this case. So these goods cost them $3,000. They're selling them for $7,000. So now we can move on to this next part. Jones pays the freight costs $350 on October 12th. Then damaged goods totaling $500 are returned to Taylor for credit on October 15th. The fair value of these goods is $50. And then on October 19th, Jones pays Taylor Company in full, less the purchase discount. So we need to first prepare the journal entries for the buyer, for Jones Company, and then we will prepare the journal entries for Taylor, the seller. So first for the buyer. So on October 10th, Jones Company purchased $7,000 of merchandise, terms 210 net 30. So they are receiving inventory here. So their inventory account has to increase. So we will debit our inventory. Now, how did we pay for this inventory? Well, those terms are telling us that we made this purchase on account. So we will credit accounts payable for $7,000. So the buyer debits inventory to make their inventory increase and credits accounts payable to make that liability account increase. Now, on October 12th, it says Jones pays the freight costs of $350. So, freight costs are shipping costs, right? They're additional costs of acquiring this inventory. It cost Jones an additional $350 of shipping just to get this inventory to their warehouse. So the buyer is going to count shipping costs under inventory. So our inventory gets debited $350. Now, how are we paying for the shipping costs? Well, we're going to use cash because it tells us that Jones paid the freight costs on this day, meaning they used cash to pay those costs right now. Now on the 15th, damaged goods totaling $500 are returned to Taylor for credit on October 15th. The fair value of these goods are $50. Well, the fair value, that's just what the seller can get for those damaged goods later on. So as Jones Company, as the buyer, we don't care about the fair value of these goods. What we care about is that we returned some damaged goods. So if we return goods to the seller, we need to show that we don't owe them that money anymore. So we debit accounts payable for this $500 of these damaged goods that we returned. And if we return goods, we don't have those goods anymore either. So we need to decrease our inventory. We need to credit our inventory for this 500. Now on October 19th, it says Jones pays Taylor Company in full less the purchase discount. So we are paying them back the full amount that we owe minus this 2% discount since we paid back within 10 days. So this journal entry is going to debit your accounts payable for $6,500. Now we got that $6,500 by figuring out the balance in our accounts payable on October 19th. We initially credited $7,000 to accounts payable back on the 10th, but then on the 15th we debited $500. So we still owed $6,500. Then we credit inventory $130. This credit to inventory is the discount. So as the buyer, you not only count shipping under inventory, but you also count discounts under inventory. So we will credit our inventory $130. We get $130 by taking $6,500 times 2%. So if you take $6,500 times 0.02, you'll end up with that $130. Now, our last account, we're paying Taylor Company in full, which means that our cash has to decrease. And so we credit our cash for $6,370. We get that by taking the $6,500 that we owed minus the $130 discount, giving you $6,370 for your cash amount. Now we can prepare the journal entries for Taylor Company, so as the seller in this case. So there's going to be some extra steps in here that we didn't have to deal with as the buyer. So first of all, on the 10th, Jones Company purchased $7,000 of merchandise from Taylor Company, FOB shipping point, terms $210 net $30. The goods cost Taylor Company $3,000. So as the seller, you need to record both the credit sale, the $7,000 that Jones Company owes you, and you need to record what these goods cost you. So we first record the credit sale. So we will debit our accounts receivable $7,000 because Jones Company now owes us $7,000. And why do they owe us $7,000? Because we made a sale. So we need to credit our sales revenue for $7,000. Now we have the second entry on the 10th as the seller. This is where that part of the goods cost Taylor Company $3,000 comes into play. So what we do here is we debit cost of goods sold $3,000. So cost of goods sold is an expense account. So we are increasing that expense $3,000. And we credit our inventory for $3,000. So whenever you're the seller and you make a credit sale, your journal entries will be set up like this, where you debit your accounts receivable, credit sales revenue, debit cost of goods sold, credit inventory. Now, the next piece of this problem is that Jones pays the freight costs of $350 on October 12th. Well, since we are now Taylor Company, we don't care about that transaction. That has nothing to do with us as the seller. So we don't need to journalize that transaction at all on the books of Taylor Company. So instead, we move on to the 15th. So it says damaged goods totaling $500 are returned to Taylor for credit on October 15th. The fair value of these goods are $50. So just like how we had two separate entries when we made a sale, we're going to have two separate entries for when there's this return. So the first entry is to deal with the damaged goods totaling $500 being returned. So we debit sales returns and allowances. It's a contra revenue account. So it's going up with this debit, and it will take away from your sales revenue when you are trying to calculate your net sales. So we debit our sales returns and allowances for the total amount that these goods were valued at. And then we credit accounts receivable for $500. So we're crediting our accounts receivable to say that Jones Company doesn't owe us those $500 anymore. Then we have this second entry on the day of the return. This deals with the fair value of the goods being $50. Well, we now have inventory worth $50 again. So we will debit our inventory of $50, and we will credit our cost of goods sold for $50. So if we compare the past two journal entries to the two that happened on October 10th, you can notice that it's almost a easy flip of accounts. The only difference is instead of sales revenue, we use sales returns and allowances, which again is a contra revenue account. So this should say October 19th. Jones pays Taylor Company in full less the purchase discount. So we are getting all $6,370. So our cash goes up. Now, as the seller, we count that discount, which we found earlier, under an account called sales discount. So we credit or we debit our sales discount for $130, and then we credit accounts receivable for $6,500. So if you are working through this problem, you would probably first figure out your accounts receivable amount. In which case you make a T account for accounts receivable, and you notice you had a $7,000 debit on the 10th and a $500 credit on the 15th, which gives us the balance of $6,500. Then 2%, because it's terms 210 net 30, so 2% of $6,500 gets you that $130 for your sales discount. And then what people owed you minus the discount that you're giving gets you your cash amount of $6,370. Now we can take a look at problem number 2. So in this question, we have this multi-step income statement, and we need to fill in the blanks. So the first blank that we're going to be looking for, and that totally messed up the formatting, but the first blank that we're going to be looking for is your sales returns and allowances. So you can notice that the relationship there is your sales revenue less your sales returns and allowances equals your net sales. So we're going to have to set up a lot of this like algebra problems. So 525,000 minus X gets you 490,000. If we solve for X, we'll see that our sales returns and allowances are $35,000. So now we can double check that 525 minus 35 gets us that 490. So now we're looking at only net sales and below on this multi-step income statement. So our net sales were 490,000. Then we had cost of goods sold, which we don't know, and then our gross profit of 280. Well, our gross profit is your net sales minus your cost of goods sold. So it's going to be set up just like we did with our sales returns and allowances last time. We take our 490 minus X, our unknown, our cost of goods sold, equals 280,000. So if we solve for X, we will find that our cost of goods sold is 210,000. Now we can take a look at our operating expenses portion. So we have these 4 different operating expenses. We have salaries and wages expense, advertising expense, depreciation expense, and insurance expense. Those 4 are going to add up to our total operating expenses of 42,600. Well, we're given 3, and our depreciation expense is unknown. So we can set this up algebraically as 22,800 plus 10,100 plus X plus 1,500 equals our total operating expenses of 42,600. So if we solve for X in this case, your depreciation expense will end up as 8,200. So now we're taking a look at our income from operations. So our income from operations we find by taking our gross profit and subtracting our total operating expenses. So we have a gross profit of 280,000. We have total operating expenses of 42,600. So if we subtract those two, that'll give us a income from operations of 237,400. Now, just realized the bottom part of this is cut off. So what the rest says is our other revenues and gains of 3,000 for interest revenue. So after your income from operations, you'll need to list out other revenues and gains and then other expenses and losses. So our other revenues and gains is that interest revenue. And then in this problem, we also had other expenses and losses. We had interest expense of 2,400. So we can then take our income from operations, our 237,400, and add in our other revenues and gains of 3,000, and then subtract our other expenses and losses, which were 2,400, And then that will help you find the net income, which is then the final piece of this multi-step income statement. So if you add in your interest revenue and subtract out an interest expense of $2,400, you should end up with a net income of $238,000. So now we can move on to Chapter 6. So Chapter 6 deals with what we call perpetual inventory systems. So we are given information here for Diaz Company in the month of September. They started off with an inventory of 200 units at $5 a piece, and then they purchased 400 units at $6 a piece. On the 12th, on the 23rd, they purchased 300 units at $7 a piece. And then it tells us that they ended up with 100 units in their ending inventory. And then below that, it says, assume a sale of 440 units occurred on September 15th for a selling price of $8 and a sale of 360 units on September 27th for $9 a piece. Whenever we are dealing with these perpetual inventory systems, your FIFO, LIFO, and moving average, we never worry about those selling prices. That $8 and that $9 are useless to us in this problem. So what we need to do is calculate the cost of ending inventory and cost of goods sold using FIFO, which is first in, first out, LIFO, last in, first out, and moving average. So we have this table that we can use to help keep everything organized. So on the first, it told us that we had 200 units for $5 a piece. So we will write that in our beginning inventory and in our ending inventory. So we write it out as 200 at $5 equals $1,000, which we get by doing 200 times 5. So we write that out for the beginning inventory and the ending inventory on September 1st. On the 12th, we purchased 400 more units. So we will write out that 400 at $6 equals $2,400 over in our purchases column. And then we head over to our ending inventory column. And you'll notice we wrote out both groups of inventory again. So since we're using FIFO in this problem, we need to know which group of inventory came in first, because then we'll be able to tell which inventory we need to sell first. So we want to write out that we still have those 200 units at $5 a piece. And then below that, we write that we now also have 400 units at $6 a piece. So in total on this day, we have 600 units. 200 of them are at one price, 400 are at another. So now on the 15th. On the 15th, we sold 440 units. So first in, first out. So the first ones that came in were those 200 at $5 a piece. So we're going to want to sell those first. But we then have another 240 units that we need to sell to make up that full $440 sale, or 440 unit sale. So what we do is we first take the 200 at $5 a piece, and then that 240 comes from the next group of inventory. So we'll take those units from our inventory at $6 a piece. So the sale that we're making, some of the units are at $5 a piece, some of the units cost $6 a piece. So then we head over to our ending inventory, and we can check back to our ending inventory on the 12th as we're doing this math. So we had 200 units at $5, and then we sold all 200 of those. So you'll notice that our ending inventory does not show any units at $5 a piece anymore. Then the inventory at $6 a piece, we had 400 and we just sold 240 of them. So 400 minus 240 gets us that 160. So we still have 160 units at $6 a piece. If you multiply 160 times 6, you will get that $960. Now on the 23rd, we purchased 300 more units at $7 a piece. So we write out that 300 at 7 over in the purchases column. Then we head over to ending inventory, and we still have those units at $6 a piece, so we need to write those down. And then right below that, we'll put this new 300 unit purchase that we just made. So we have 160 units at $6 and 300 units at $7. So we have a total of 460 units right now. Now on the 27th, we made a sale of 360 units, selling them for $9 a piece. Well, we said earlier that we didn't care about that selling price, so that $9 isn't going to be helpful, but the 360 units will be. So it's first in, first out. So we look back to the inventory that we had going into the 27th. We had 160 at 6 and 300 at 7. So first in, first out. So we are first going to sell those 160 units at $6 a piece. But since this order was for 360 units, we then need to sell an additional 200 units at $7 a piece. So we sell 160 at 6 and 200 at 7. Then we look over in ending inventory. Well, we sold all of our units that we had at $6 a piece. So we don't have any more of those, so we don't write any inventory at $6 on the 27th. But we had 300 units at $7 a piece, and then we sold 200 units at $7 a piece. So we're left over with 100 units at $7 a piece. And you'll notice that it tells us on the 30th, at the end of the month, you should end up with 100 units. So that's a check as you're going through problems like this to make sure that you are on the right track. So now we need to figure out our cost of goods sold and our ending inventory. So for cost of goods sold, we are just going to look at the middle column, the cost of goods sold column. And we're going to look at the total values. The $1,000, the $1,440, $960, and $1,400. Your cost of goods sold will be the sum of all of those. So if you add all of those up, you get a cost of goods sold of $4,800. Ending inventory is even simpler. So for ending inventory, we just look at the last day, and we want to know the total value of that inventory that we had on the last day. So that's our 700. Now we can work on LIFO. So the transactions are all the same, but we're going to end up with different values for our cost of goods sold and our ending inventory. So LIFO stands for last in, first out. But here on the first, everything's the same. We still started off with 200 units at $5 a piece. So that's written down for both the beginning inventory and the ending inventory on September 1st. The next day, on the 12th, we made a purchase of 400 at $6. So we write that over for our purchases column. And then over in ending inventory, we rewrite out the 200 units at $5. And then below that, we write the 400 units at $6. So far, everything looks exactly the same as it did for FIFO. That's going to be the case for FIFO and LIFO until there's a sale. So here on the 15th, we made a sale. We sold 440 units. And this is where things start to change. Under LIFO, the first units that we sell are the last ones that came in. Last in, first out. So the last ones that came in were those 400 units at $6 a piece. So we're going to sell all of those. Now, the order was for 440 units. So we still need to sell an additional 40, and those will come from the $5 inventory group. So we sell 400 at 6 and 40 at 5. And then we look over in our ending inventory, and we'll go piece by piece here. So we had 200 units at $5. We sold 40, so we have 160 units at $5 a piece left. 160 times 5 gets you $800. Now we had 400 units at $6 a piece, but we sold every single one of those. So that's why we don't have any units left at $6 a piece. Now on the 23rd, we made another purchase. We purchased 300 units at $7 a piece. So we write that over in our purchases column, and we write that in our ending inventory column. So you'll notice again under ending inventory, both the units at $5 and the units at $7 are both written out, because that's what we have in our inventory on this day. Now on the 27th, we sold 360 units. So under LIFO, the first ones that we're going to sell are the last ones that came in. Well, the last ones that came in were those 300 at $7. So we're going to sell all 300 at $7. And since the order was for 360 units, we still have to sell an additional 60. And those are going to come from the other group of inventory that we had, the ones at $5 a piece. So we sell all 300 at 7, and then we have to dip into that group at $5 a piece. So for our ending inventory on that day, we had 160 units at $5, but then we sold 60 of them. So that left us with 100 units at $5 a piece. 100 times 5 gets you 500. Those units at $7 a piece that we had previously, we sold all of those on the 27th, so we don't have any of those left. So now we can calculate our cost of goods sold. So it's going to be the same process as it was for FIFO. We need to take all of the totals of our two sales, so 2,400 plus 200 plus 2,100 plus 300, and the sum of that will give you a cost of goods sold of $5,000. Then our ending inventory. Our ending inventory, once again, is just looking at the last day. So on September 27th, what was your ending inventory worth? It was worth a total of $500. Now we can take a look at average cost. So, FIFO and LIFO changed from each other when there was a sale. Average cost is going to split off from those when there's a purchase. So the first day is exactly the same. We had a beginning inventory of 200 units at $5 a piece. That was also the ending inventory on that day. The 12th is where things get a little different. So, here's what we need to write out. Our beginning or our purchase on the 12th was 400 units at $6 a piece for a total of $2,400. Now, for your ending inventory, what we do is we add up our number of units. So we had 200 units. We just bought 400 more. So now we have 600 units. So we write 600 at. And then we leave some space because we don't know this 567 right now. So 600 at, leave some space and write an equal sign. We then combine the total value of our inventories. So we had inventory that was worth $1,000. We just purchased inventory worth $2,400. So 1,000 plus 2,400 equals 3,400. Now we can take 3,400, divide by 600. So we take the total value of the inventory divided by the number of units you have. So 3,400 divided by 600 gets you that 5.67. So the average unit cost of your inventory is $5.67. Now there's a check to make sure that we're in the right ballpark for our average unit cost. We're averaging inventory here at $5 and $6. So our average unit cost has to be somewhere between those. If you got an average unit cost of $2 or of $35, you know that you need to take a step back and recalculate. But since we're between 5 and 6, we're good. So now here on the 15th, we made a sale. We sold 440 units. So what we do is we write down that we sold 440 units at the current average unit cost. So we write 440 at $5.67 equals 2,493. So we then take a look at our ending inventory. We had 600 units. We just sold 440 of them. So we can write 160 units for our ending inventory. For our average unit cost, you'll notice it did not change. That average unit cost will only change with a purchase. So we can write out that our 160 units are at $5.67. You multiply those together and you will get 907. Now on the 23rd, you make another purchase. You purchase 300 units at $7 a piece for a total cost of $2,100. So we write that purchase over in our purchases column. We write 300 at 7 equals 2,100. Then we head over to our ending inventory. And just like we did back on the 12th, we have the same steps here. First, we need to add up the number of units that we have. We had 160 units. We just purchased 300. So 160 plus 300 gets us 460 units. So we write 460 at, and then we're going to leave some space. And we write an equal sign. And then we combine the total values of our inventory. So we take that $907 and we add in 2,100. So 907 plus 2,100 equals 3,007. So we have 460 units that are worth a total of $3,007 right now. We take that total value, that 3,007, divide that by the number of units we have, the 460. So 3,007 minus 4, or divided by 460 equals $6.54. That $6.54 is your average unit cost. And we can check again to make sure that we're on the right track. We're averaging inventory between $5.67 and $7. Well, our new average unit cost is between those two amounts, so we're okay. Now, on the 27th, we sold 360 units. So, all 360 will be at the most recent average unit cost. So, 360 units at $6.54 equals 2,354, leaving us with 100 units remaining. And again, the average unit cost does not change with a sale. So our average unit cost is still $6.54. So 100 times $6.54 equals $654. So you'll notice that when we did FIFO, LIFO, and average cost, we ended up with 100 units at the end each time. The values, the total values of our ending inventory, those were all different. But the total number of units, that did not change. So now we can calculate our cost of goods sold. So our cost of goods sold we're looking in just our cost of goods sold column right now. And we take the total amounts. So we take the 2,493 and we add in the 2,354. So your cost of goods sold equals 4,847. And then we can find our ending inventory. Well, just like FIFO and LIFO, we look at the value of our ending inventory on our last day. And on September 27th, our ending inventory was worth $654. So let's take a look at the cost of goods sold and ending inventory that we calculated here. You'll notice that FIFO had the lowest cost of goods sold and the highest ending inventory. LIFO was the opposite, highest cost of goods sold and lowest ending inventory. And average cost is in the middle. So, FIFO, lower cost of goods sold. What is that going to do for a company? That's going to give them a higher income, right? Because back when we solved for our the blanks in the multi-step income statement, cost of goods sold, that was an expense. So if we had a lower expense, we could have a higher net income. So LIFO. Well, LIFO has a higher cost of goods sold, so that's going to give us a lower net income. So why would a company ever want a lower net income? Well, a lower net income means lower taxes. So a company can use FIFO or LIFO or average cost and get these benefits. Now, they're not going to constantly be switching back and forth. They're going to pick one and stick with it. But you'll notice that the sales that were made were exactly the same. They made sales on September 15th and the 27th. The way that they valued the cost of those sales changed throughout the three different methods. And so that's how a company can mess with the numbers a bit here to either get a higher net income or a lower net income. So the last problem is dealing with the lower of cost or market valuation. So it says Larkin Company accumulates the following cost and market data at December 31st. So we have three different inventory categories. We have computers, speakers, and keyboards. And we're given cost data and market data. And then it says compute the lower of cost or market valuation for the company's inventory. So the way that we do this is we break it down piece by piece. So we're looking at just computers right now. The lower of cost or market for computers, well, the cost data shows 15,000, but the market data shows 14,700. So we're going to choose that 14,700 because that's the lower of the two. So the market says that it's worth 14,000. The cost said it was worth 15. But we want to go with the lower of the two. So we'll choose that 14,000. Speakers. The cost was 10,500. The market says 8,250. Well, we'll go with that 8,250 because that's the lower of the cost or market. Keyboards, The cost data shows 12,750. Market data is 13,000. Well, this time cost data is less, so we'll go with the cost data of 12,750. So our inventory will be worth the sum of those three amounts, the 14,700, 8,250, and 12,750. You add those three together, and the lower of cost or market valuation for the company's inventory is 35,700.